Hello, friends. Welcome to this special episode. In this episode, we will have two case studies, one of the US markets and that of Indian markets, and to showcase how strength of stocks changes over periods of time and the fact that any stagnant or fixed portfolio is actually a sure short way of losing relative performance to the market. So, for instance, let's start with this example that you've all heard of the Magnificent Seven in the US markets. What are these Magnificent Seven? These are seven companies that are just flying off the charts versus the rest of the market. So, if the rest of the market is here, these guys are here, and this concentrated seven stock selection is actually driving the overall bulk of the index. So there's Nvidia, there's Tesla, there's Microsoft, there's Google, Amazon, Meta, and Apple. These are the seven stocks in consideration. If I were to see this current calendar year starting January 2024, one stock is up, like 160%. One stock is down 23%. Rest are between 20, 30, 40%. So it's very difficult to say, which ones could be this or which one could be this one, but maybe some of you may have guessed it. So if I were to just disclose that, it would be Nvidia, which is 162% up in just less than 6 months. And Tesla is down 26% in just less than 6 months. And the rest of the market is between 12 and 43%. The entire market, the Nasdaq market, is at plus 19%. So the setup is like this, that the 100 stocks that we're looking at, uh, most of them are in or around the uh, index range, and there are some outliers which have done really well and some underperformers that have done really bad. This is the usual makeup of any index. I mean, whether it is Nasdaq, S&P, Nifty, any index that you make up. Now, uh, what would have happened if you did not have Nvidia in your portfolio, for instance? So, significant part of this year's move you would have missed if you were selecting stocks basis some other mechanism. One is, of course, if you had the index, you would be making 19%. But let's say you had index stocks, but you didn't have Nvidia, you would actually underperform the Nasdaq likely in a very big way, right? So to dive deeper into this, let's see the relative movement of these stocks in the past. So if I were to really go back, then Microsoft has been the blockbuster sort of mover from 1987 to now. It is up 59,000%, whereas Nasdaq market, which is also considered to be a great index to invest in, is up only 2,200%. So one component of the Nasdaq has clocked 59,000%, whereas the overall market is at 2,200% over a period of a good 13 years here. Then in the period of 98 to 2000, the dot-com boom period, you saw Apple really take over the lead, and in this two year and 1 quarter period, Apple went up 1,000% nearly. Microsoft was up 269 and the index was up 391. So in this period, Microsoft was not outperforming the overall index, but Apple had taken the lead and Apple was pulling up the entire index. If I were to come further out from 2003 till 2007, you saw Apple go up crazily. So Apple in this period is up 3,000%. That's like 30 times in a period of 4 years. And at the same point of time, Microsoft in this period is up only 65%. The overall index is up only 94%. I'm saying only because in relative to Apple of 3,000%, the market is up only 94%. So if you missed Apple in this period and you were invested in Nasdaq stocks, I mean, you really missed it out in a very big way. Then, if you were to compare other stocks also in the same time period, Nvidia which is now a rock star, in that period from April 3 to December 2007 was up 687% only against Apple of 2900. Amazon was also dull at that time at 266 versus Apple. So you can see how at different times different stocks have really played well. And then 9 to 12, 2009 to 12, you can see that in the previous one, Amazon was kind of trailing Nvidia by a wide margin. Amazon had done 266, Nvidia had done 688. And here in the next 3 years, Amazon is up 400% and Nvidia is up only 71%. And Apple, of course, continues another 700% on top of where it was in the last time. So these stocks are, sort of playing a relay race. And Nvidia in the last Feb 16 to August 18 period just went bonkers, 1000% up, whereas the market was only 89%. Amazon was at 297%. And 19 till pre-COVID, you had another player that really emerged out of nowhere, and that was Tesla. So Tesla went up 2200% in this very short 1.5 year period, whereas everything else was either double digits, or Nvidia at 300% is not even comparable to this. So while other stocks are also performing reasonably decently, uh, you know, Tesla really, took the entire hogged the limelight. Then you had the next year and a half where Tesla was again up at 1329%, Nvidia also up 500%. And just look at all these others, Google at 178, Apple at 167. These are still fantastic numbers. Apple at Amazon at 90%, but nowhere in comparison to the leadership of a few stocks at that point of time. And then very recently, if I were to see the last couple of years, Nvidia is again up 1000%. Meta has come up now. So what was leading in the previous session, Tesla has dramatically gone down. Tesla is down 10% in this period. Meta is up 291%, followed by Microsoft and Google. So Google never really coming around to be top of the tops, or Amazon for that matter, but they have done well individually. But compared to these kind of leaders, they were not really there. So you can see from these examples how different periods over the last, let's say, 25, 30 years, different stocks have performed brilliantly in different pockets, and you needed to have, allocation to those stocks at those times to really make the best of all times. You could have had just the Nasdaq index in a ETF and enjoyed some secular run, but if you were able to select the strength of that index at different times, the outcome could be, phenomenal from that point of view. Now let's take a look at Indian context. So we'll take a banking example, and we'll choose the two top private banks, HDFC Bank and ICICI Bank. And let's say the last 2001 to 2007 till the GFC top, uh, HDFC Bank, and this will be surprising to a lot of folks because a lot of folks ascribe that, HDFC Bank has been the top of tops of the last 25 years, but this is hard data in front of you. HDFC Bank went up 800% in this period of about 7 years, 6 years, six and something. Bank Nifty as a whole went up 1300%. So 100 rupee here was up by 75%. So it's about 8 times. Bank Nifty was up about 13 times, and ICICI Bank was up at 21 times. So crazy kind of a difference between what ICICI Bank did and what HDFC Bank did. Almost a 3 times more gain in ICICI Bank versus HDFC Bank during this period. And today, if you were to ask most people about HDFC versus ICICI, they would say HDFC Bank has been performing from 1999, and it has never been beaten. That is the perception. Now, in the next period from January 8, from great GFC global financial crisis till, let's say, pre-COVID, HDFC Bank did extremely well. So HDFC Bank was up 740%. ICICI Bank in that period could manage only 175%. So almost like, 5 times more growth happened in HDFC Bank stock in this period versus ICICI Bank, and the Bank Nifty was also nearly at 216%. Now from post-COVID to present day, again you can see HDFC Bank in the last, let's say 4 years is up 82%, which by itself is not bad. But Bank Nifty is up double of that, 161%. And if I were to see ICICI Bank, it is up 3 times of HDFC Bank in this period at 255%. So in the last 20-25 years, there have been pockets where HDFC Bank did really well. There were pockets where ICICI Bank did very well. And overall, of course, both have done reasonably well. So if and this is an example of one versus other, but if you expand this, say, okay, there are 50 stocks, and 50 stocks I want to, uh, see which stocks are relatively doing better than one or the other, then you will find that there are always stocks that really are outperforming the others. So that is the idea of relative performance of one versus the other. And also, the way, especially in the US example, you saw how easily things are getting disrupted. So while nobody was talking about Tesla till a couple of years back, suddenly Tesla came into the being and disrupted, all the Toyotas and BMWs of the world, and then reversing also to some extent. And then now Nvidia is rising like a phoenix from nowhere. Market cap of $3.5 trillion now, the most expensive company on this planet Earth. That one company is now worth more than German entire stock market cap, more than entire UK market cap. So you don't know what will be the next Nvidia, what will be the next kind of movement, which few stocks will be, the next sort of uh, reason why, your index may perform really well. Now imagine you are holding conventional portfolio based on earnings and all those things, and your stocks are not moving, but these kind of companies come around without any earning right now, or without having any respect for any price earning ratio or anything, and 100 times PE, and money is just piling in, and it's a runaway rally. Why do you want to miss that rally? Yes, someday everything will correct. These two will also correct, but make the best of what is available to you while it is happening. So this also shows, I mean, there's one chart that I should have included in this. There's a very beautiful chart of Intel versus Nvidia, uh, both in similar business. And the point there was that if you invested 10,000 in Intel 20 years back, it's somewhere close to 14,000, and in Nvidia it becomes like 10-20 million, something like that. So this is the kind of disruption or disruptive at times that can happen. And in general, also you will see, and this data shows you that the average company lifespan in the index has been gradually receding. So earlier in the 60s, you used to have a company which stayed in S&P 500 for average 30-35 years. Then it became 20-25 years, and now it is sort of coming down to 10 or 12 years. So an average company comes into S&P 500, stays for 12 years, and goes up. I mean, it has peaked in performance or its scalability, and then some other technology or something else take over, or somebody acquires it, and the longevity of it from the index goes away. So new leaders will emerge out of nowhere. Nobody will be able to predict that. This prediction of what will be the next multi-bagger, when people say that, and they say that, okay, we will give you 5 multi-baggers this year, and all that kind of talk, I mean, it is pure nonsense, really. I mean, nobody can really predict what stocks will be the leadership. And you have seen yourself in the last 2 years, was anybody able to predict that defense stocks, public sector enterprise stocks, public sector banking stocks, real estate stocks, was anybody able to predict what will happen in these sectors, how these companies will emerge as winners for this last 12, 15, 18-month period. Nobody was able to do that and nobody can do it consistently. Sometimes somebody may be right, but then nobody will be able to do it consistently. So this buy and hold, and sleep, that okay, I've done some, screening based on some numbers, and I'm going to buy and hold this because the numbers have been great in the past. Well, they have been great in the past. That is the rear view snapshot. It is telling you nothing about the front view. Your company may have done very well in the past, but there may be an emerging company which is going to, do so well, or bring that kind of technology, or do whatever marketing stunt that they will do, that it's going to destroy, your great company's moat. That is always possible, right? So your company may be sitting at 60, 70, 80 times earnings because there was no alternative to this company, and then this other company comes around and it just takes away market share within 5 years, and that there's only a PED rating that continues to happen in your company, even with earnings going up, and while the other company goes through a market cap of 20 times doing that. So coming back to the analogy of how to sort of look at the potential of strength in a pack of stocks. So again, I'll give you the same example which I quote many times, that it's a horse race that is happening, and in that derby you want to select the group of horses that are most promising, not because they have won past races, but because in this race they are leading from the front. So there are stocks which are showing you in the current race that they are unable to keep pace, right? They are not in the leadership position. After 3 rounds, these horses have stayed back. There are others who are showing promise, that this is a new generation of companies, and this is the the cutting edge, and cheaper access to capital, or whatever may be their moat, or whatever may be the reason investors are willing to bet on them, and liquidity is flowing towards that stock, and they are in leadership position. You want to bet on that, right? So the idea should be that you should have a strategy that be able to better identify future leaders well in advance, right? So past leadership need not mean that future leadership will remain. As I showed you, in not only in the US example, but in the India example, how the leadership also keeps changing, especially from a stock market perspective. Uh, a company may be growing very large, but its stock price may not remain the best performing stock at all times. As I say often, there is a bad price for a good company, and there is a good price for a bad company. You want to buy stocks where you will make money in the market. Your aim is not to have the best company in your portfolio. Your aim is to make money in your portfolio. Let this not clash or get confused. This whole thesis that you are here to make money from the markets, or in case you are not having that vision, you are saying that an alternate vision could be that I have the best companies, the best management, regardless if they are not valued by the market at the highest point for whatever reason. Let's say there's a wonderful company with a beautiful product and a extremely transparent management, but they are not hungry for growth. They are happy with gradual growth, versus somebody else who's very hungry for growth. They're leveraging, they are diversifying across the world, and they're doing all kinds of things, but may not be as good as this company in terms of value system or management. Market is going to give that company a boost like nobody's business, right? So you need to see what are you looking for. So distilling this now to sort of momentum investing. So this is what momentum investing is all about. It is all about staying with the winners and exiting the losers. In most cases, people don't exit their losers, even if they are not classified as losers. But when they're not able to be in that strong pack, they're actually losing. Even if your stock is making 15% CAGR and some other stock in the same business is making 25% CAGR, your stock is losing. Although on an absolute basis, you may not be losing, right? So relatively, everything is relative now. So during a bull rally, not all stocks will perform. So some may be flat, some may underperform. So we don't want to be stuck in stocks which don't do anything. Index investing has this biggest issue. When you invest in the index, you invest in the strong stocks, you invest in the mediocre stocks, and you invest in the weak stocks of the index. And you have to buy all of them together. The contention that I am trying to make is, why should I buy the weak stocks and why should I buy the mediocre stocks? I only want the strength. And that is why when you will do that, you will find that you are beating the index all times, at all times, because you are only concentrating on the strength of the index. So this is where it can get very, very clear in terms of the path for sustained success, that you need to have a systematic way of rotating into stronger stocks and letting go of weaker stocks. It is like survival of the fittest, the theory of survival of the fittest, that you need to be with the fittest, and the weak will have to die and you will have to give them up, so that your performance in your portfolio can shine out. That's all for this episode. I hope you like the content. Do comment in this episode how you react to this content, and what are your thoughts about this way of selecting stocks. Contra views are most welcome. We learn by reading about each other's contrary views also. Please be liberal in sharing your views, and also in liberal in liking and sharing this video. Thanks. Bye.